Yeah. So reading 86 basics of portfolio planning and construction. Now from here on it will become little theoretical, easy also, more like self-reading kind of thing only. See, portfolio planning and construction, but very important as well. Okay, this topic is very important one. Investment policy statement. Okay, investment policy statements. Now, what is this investment policy statements? This is uh, major components of investment policy statements. Is this? I would advise you to read from the curriculum. Investment policy statements. That also, let me see if I can show it to you. Around 10 pages are there. Most of the questions they are asking from the in the website, you will find many questions from the curriculum of IPS. Okay, that investment policy statements. I'll show one to you. Uh, Portfolio management. This part 162 to, I would say, 174. You read it. Okay, investment policy. Can you see here? Hello. Hello.
Yes, sir.
So this one you mark it. Do you have the curriculum with you? Do you
I
have?
have the PDF.
So you have this curriculum PDF,
Yes,
right?
PDF.
Okay. So you read from 161 or 162 to 174. Okay. All this around 10 pages, 10, 12 pages you read, because they are asking, but all self-explanatory only, very easy only. If you find any difficulty, you ask me. Okay. But they are asking any lines from this curriculum directly. Okay.
Okay.
The major components. This is very difficult now. This is memory based one. If you ask me, I will find it difficult to remember all these things. So it is up to you whether if you can remember. Otherwise, it's fine, leave it, because then you will have to take risk. Like if I have to do this, for me it's difficult to go by memory based question. So I will skip it. Okay. But what I will do is I will read those 10, 12 pages, and whatever I can get, whatever I can remember, that I will take. Whatever I cannot, I will just skip it. Okay, because I will go by my strength and weakness. Similarly, you go by your strength and weakness. If you are able to, whatever you can remember, you remember. Okay.
Okay.
And when you will get questions, again go back to the book and then again check. That way it will be easier to remember. Then risk objectives in an investment policy statement. Absolute risk objective and relative risk objective. Okay. Now, what is absolute risk objective and relative? Absolute means you are not comparing with any other fund or portfolio or index. Relative means you are comparing, comparative one. For example, if you say absolute risk objective, that I risk objective, right? Okay, so the absolute risk objective might be to have no no decrease in portfolio value during any 12 months period, or to not decrease in value by more than 2%. So if I say my portfolio should not go down by more than 2%, that means that is what absolute risk objective. That is absolute risk objectives.
Okay.
Okay, because I'm not comparing with anybody else. All I'm saying is it should not go down by more than 2%, or at least I should get minimum, let's say fixed deposits return 6% in my portfolio. Okay, or my portfolio should not go in red color at all. So all these means what? Absolute risk. Now what is relative risk? Relative risk means comparatively, like say for example, my portfolio should not go down more than Nifty. So if Nifty is going down by 3%, my portfolio also maximum should go down by 3% only. It should not go beyond 3. Okay.
Okay.
That is relative risk objective.
Okay.
Like
Yeah.
no greater than 5% probability of returns, or more than 4% below the return on the MSI. So I'm comparing with MSI World Index. This is Morgan Stanley Composite Index. These are world index. So I'm comparing with index. Like as I said, my return should not be lower than Nifty's return. Then it is what? Relative risk objectives. Okay. So you can just quickly go through this. Just take a minute, quickly read this.
Okay. Done, sir.
Okay. Now, investors' ability to bear risk, willingness to bear risk, both are different. Ability to bear risk means, for example, 20-year, see, longer investment horizon, great. Ability to bear risk means, imagine, say, for example, there is a rich person. They might have ability to bear risk, or uh, ability to bear risk. Okay. Then ability and willingness, right? Ability and willingness. Um, uh, or imagine a young guy ability to bear risk, so he can be a long term investor, so he has the ability to bear risk, but but will he be willing for it? That is a question mark. Okay, and investors, then the second part is willingness to bear risk. Willingness to bear risk means, say for example, uh, quite possible that a person is ready to take risk, but then he does not have the ability to take risk. Okay, willingness means he is ready to take risk, but he is willing, but then he does not have the ability. And ability to bear risk means he has the ability, but he is not willing. Say, for example, a young guy who is a short term trader. Now he has the ability to bear risk for long term, Okay, but still he does not have the patience, he does not have the willingness, so he goes for short term. Okay, you're getting the difference between these two: ability to bear
Yes.
risk and willingness to bear risk. So a young guy who is a short-term trader, he has the ability to bear risk, but he does not have the willingness to bear risk.
Okay.
Okay. Investment constraints. So there can be constraints also in investments. Why? Because investors' liquidity needs will be there. He will require money, time horizon. He will say like I can invest only for 3 years only, 5 years only. Okay. Then tax consideration, legal and regulatory constraints. So regulatory constraints as in money can be, say for example, you may not be allowed to invest in China. Okay, whereas China might be flourishing possibly. So these are regulatory constraints. Okay, or you are not allowed to invest in US or some kind of restrictions regulators can put anytime. Okay, these are all constraints. Yeah, this word is important. Strategic asset allocation. Strategic asset allocation means initially based on the investment objectives. Say for example, we have decided that that let's say 60 percentage of the money should go into equity, 30 percentage of the money should go into bond, 10 percentage of the money should go into gold. Okay. Okay. Yeah. So uh, this is called strategic asset allocation. Strategic asset allocation. Strategic asset allocation. Now, what is the other term is tactical. Yes, I think I missed. Strategic asset allocation. Strategic asset allocation means based on the objectives, based on the long-term objectives. You have decided that 60 percentage of the money should go into equity, 30 percentage into bond, and 10 percentage into gold. Okay. Now the next term is tactical asset allocation. Tactical asset allocation. Tactical asset allocation means what? Tactical asset allocation. Tactical asset allocation means imagine suddenly some event happens. So say for example trade war and all that things are happening. So at that time quite possible that equity is not going to do very well. So at that time you also know world war, some kind of war and all those things are happening. So gold is going to do very well at that time. So you might want to reduce your exposure to equity, let's say instead of 60 maybe to 30 percentage, and the bond to be 30 percentage, and gold to be 40 percentage. This is tactical. Tactical means temporarily, okay, for few, let's say weeks, months, you are doing like this to take advantage of the current situation. So the current situation is what? The current situation is war is going on, trade war is going on, and you believe that gold is going to do very well. So temporarily you will park more money accordingly in another uh, product based on the situations. And then once all these uncertainty gets over, then again you will come back to the normal one. That means this one. So this is tactical asset allocation. So tactical is more like temporarily adopted strategy. Strategic is long-term adopted strategy.
Okay.
Security selection refers to the deviations from index weights on individual securities within an asset class. Okay. Refers to deviation from index weights on individual security within an asset class. That means deviations from index weights. Say for example, now this is Nifty index. Now in Nifty index, imagine bank. Just imagine only two index, okay, bank and IT. So let's say bank is 60% and this is 40%. Now what you are doing is you are investing in bank, but maybe you are not so very optimistic with bank. You are investing 30% and you are more investing all into IT. This is called security selection, deviations from index weight on individual securities within the asset class. Deviations, no, 1 minute. This is uh, deviations from index weights on individual security within an, no, not this one. See, Nifty, bank. Now bank has let's say bank has ICICI and HDFC Bank. Okay. And IT has Infosys and TCS. So ICICI, let's say here it is, this is for 60 percentage. In that 60 percentage, maybe like here it has 30 and here it is 70. Okay, here it is 40 percentage. In that 40 percentage, this is 40, this is 50-50. Okay, okay. So now within the refers to deviations from index weights on individual securities. So on individual securities means what? Now here instead of 30 you might be going for 40 and 60, and here you might be going for 20 and 80. These are the deviations in the securities, that is security selections. Understood this part?
Yes.
Okay, you are deviating in the security selections. Okay, that means change in weight. Basically it means change in weight of the securities. Okay. A portfolio manager, they have given example. A portfolio manager might overweight energy stocks and underweight financial stocks relative to the index weights for US. They are even saying overweight financial stocks. Okay. Related to the index weight for US large cap equities as an asset class. For some asset class such as hedge funds, individual real estate properties and artwork, investable indexes are not available for these asset classes. Selection of individual assets is required by the nature of the asset class. Okay. A portfolio manager might overweight energy stock. Okay, they are even changing the weight also as well. So that means even what I thought previously that also works here. That means if this is bank and this is IT, overall if this is 60 and 40, you just think that these are all the changes they are doing, okay? So which they are changing it to 30 and 70. This way is also possible. Changing the index weight is also possible. Okay. Okay. Then risk budgeting. Risk budget means basically budget means how much risk you want to take. Like we do budgeting, right? Budgeting means how much money we want to spend money. Okay. Similarly, risk budgeting. Okay. Okay. Risk budgeting means how much risk the company can take. That is risk budgeting. So a practice known as risk budgeting sets an overall risk limit for the portfolio and budgets a portion of the permitted risk to the systematic risk of the strategic asset allocation. Fine. Core satellite approach. The core satellite approach, this word is important. The core satellite approach invests majority or core portion of the portfolio in passively managed index and invest a smaller satellite portion in active strategies. So you are able to understand. Say for example, 90% of the money you are investing as per index, and then 10% you are deviating from index and investing through active strategies. Then this is what core satellite approach. Okay, so core satellite approach means majority money you invest through passive way, little money you invest through active way. That is core satellite. Approaches to ESG investing include ESG investing include ESG as in environment, social, and governance. Okay, so here negative screening, that means which are not following ESG, excluding certain companies or industries based on ESG factors. Say for example, alcohol companies, they don't fit into ESG factor. Alcohol companies, then tobacco companies, okay, or mining companies which spoils the environment. Positive screening means green energy, a green energy company, or EV vehicle, electric vehicle. This all falls under positive screening. Then thematic investing. Thematic means investing into certain themes like ESG related one, selecting sectors or companies to promote specific ESG related goals. Okay, these all are not so important. These three, especially first two, is an important one. Even third also you can know. These three you can ignore. Okay, these three you read.
Yes, sir. Done.
Uh, The behavioral biases of individuals. Okay, cognitive errors and emotional bias. Cognitive means logical error. So logical error means what? So logical error as in, see, there is something wrong in my reasoning, irrationality. These are more logical. So for example, I did not understand something properly. I did not understand the business. Okay. Or I did not model it properly. Uh, I have finished quantitative methods for you, right? Or not yet?
Finished.
Quantitative
Yeah.
finished, right? So there we did like this linear regression, right? A plus b
Yes.
linear regression. So imagine there is something wrong in the modeling itself, something wrong in the data. Then I am not able to understand properly, or I did some mistakes in calculating the value of y. All these are cognitive error. Well, these are what? These are all statistical analysis, information processing. All these are logical error. Okay, these are logical. Then another one is emotional problem, emotional biases. So emotional biases means what? They are not, they are not related to conscious thought. Rather, they stem from feelings, impulses, or intuitions. Okay, emotional problem. Say, for example, I am emotionally attached to some stock. Okay, why so? Because this is my first stock I invested in. Now I am not going to sell it, even if it is a bad stock now. So what is that emotional problem? No? Now
Yeah.
it is coming out of my feelings for that company. Or imagine some company which has been gifted by my parents to me. So because I got it as a gift from my parents, I will not sell it. Now that is not right. Correct? If the company is not good, why are you keeping it? Understood? If the
Yes.
company is not good, there is no point in keeping it. No. So this is the problem. Okay. These are all emotional problem. So cognitive error, cognitive dissonance refers to a situation where an individual holds conflicting beliefs or receives information that causes a current belief to be questioned. Okay. Cognitive dissonance refers to a situation where an individual holds conflicting beliefs or receives information that causes a current belief to be questioned. Okay. Uh, okay. Individual holds conflicting beliefs or receives information okay, conflicting beliefs or receives information that causes a current belief to be questioned means what? Say, for example, I think that real estate is a good investment. That is my history. That is what my belief is. Now suddenly I get to know that real estate is not growing the way it is supposed to grow. So, but still I will not believe, right? So these are all cognitive dissonance. Okay. See,
Okay.
prior belief in favor of conflicting belief. Okay. Conflicting, basically different thoughts are coming. So far I was thinking that uh, real estate is a good investment. Now it turns out to be not so very good. Okay. Conservative. All these are just self-explanatory. Conservatism bias means you are not ready to change your thoughts. What you thought before, only that is the case. Occurs when market participants rationally from an initial view, but then rationally form an initial view, but then fail to change that view as new information becomes available. So you are being very conservative in the thoughts then. You are not ready to change with the new, changes that are happening in the market. As I said, or some people will say, right, that government companies, they will not invest in government companies. But then again, conservatism bias, right? So initially that might have been a good idea. Now maybe government is investing heavily in railway stocks and all. If at all that happens, then I should change my mind then accordingly. Okay, so I cannot stick to only one method. Okay.
Yes.
You can read this one, conservatism bias.
Yes, okay.
Mm. Now all it will be like this only. Okay. Representative bias. Under that, base rate neglect and sample size neglect. I'll talk about sample size. That means imagine um sample size neglect means you are taking, or imagine you want to know whether a particular company is good or bad, and you asked only one person or 1 2 3 person. So, and then you are forming an opinion. That is called what? Sample size neglect, because your sample size was too small. Okay. So when you are asking only to 1 2 people, quite possible that in that team, let's say they are saying they are giving you bad feedback, but in that team it was the case, but otherwise there might be some good team as well, no?
Yes.
That is representative bias, wrong representation. Okay, wrong representation. Because just with smaller samples, if you are framing an opinion about a bigger company, that shows what? Your thoughts has representative bias. Okay.
Okay.
Then base rate neglect. Base rate neglect means uh, imagine, for example, uh, you are not imagine you are not keeping well, and you have scored in your test very less because you did not study. Okay, so it is, let's say in your test you scored 40 percentage. Then what happens? Then you are studying well. After that you are becoming normal. You are studying well and you are scoring 80 percentage. Now there is 100 percentage jump in your marks from 40 to 80. Okay, now
Yes.
you have done very well, but it has what? Base rate neglect, because from 40 it is easier to come to 80.
Yeah.
Base rate 100, I'm saying 100 percentage, you have jumped, but then 100 percentage you have jumped, but your base rate is also very low, no?
Yeah.
Okay, similarly you remember during COVID times and all, the GDP went down highly and then it jumped up highly. So that time it was all like, oh, GDP is doing very well. It was not doing very well. It is just that base rate neglect. From a very low base, it is going up. Okay. And then from 80, are you able to score to 90? It is very, very difficult for you. Okay. From 80, you are not able to go to 90. Okay. Why? Again, base rate. Because here now the base rate is very high. Right? Imagine you are scoring 80%. From 80 to 90, it is very difficult to score. Or from 90 to 95, it is even more difficult.
Yes.
Okay, you understood this term, base rate neglect and sample size neglect.
Yes, understood.
Okay, you can just, but you have to peacefully read. Okay, see, this is a very easy reading, but important reading. Why? Because this is what people are lacking in the market. Okay, it is not the this logical problem. It is the emotional problem. People fall into trap. You must be hearing so many scams happening around. People become too greedy, so they are not able to have control on the emotions that they are supposed to have towards the market. Okay, so this is a very important one, but very easy one only. You may just
Okay.
go through this now. See, if the analyst exhibits sample size neglect and base rate neglect biases, the analyst will ignore XYZ's long record as a growth stock. Focus on the short-term disappointing, say short-term disappointing results. So if short-term it is disappointing, and if you're concluding that your stock is bad, then it is representative bias, no? Only based on short-term you are deciding. Okay, imagine one quarterly result is bad, and you are thinking that now you want to uh, one quarterly result is bad, and now you are thinking that you want to sell off. Then this is what representative bias.
Right, yeah.
Okay. Or imagine one good growth is happening and you are thinking that forever it will grow. Then again representative bias. Fine,
Okay.
okay. Illusion of control. So in market people have this kind of emotions. Here one example that they have given is it is often associated with emotional biases. Illusion of knowledge. Believe that you know things you do not know. Self attribution. Believe you personally caused something to happen. Overconfidence. An unwarranted belief that your belief will prove to be correct. That means if I am entering into the market, that stock has to go up. Illusion of control. Correct. People tend to think of themselves as the superhero. Okay. So if they are buying, you know, like people will always think, like, for example, imagine there is a penny stock. Now, ideally, one is not advised to invest in penny stock. But people will have this kind of, if you are entering into that penny stock, okay, then what does that mean? You are thinking that you will be able to control the situation. It is
Yes,
penny
yeah.
stock. Okay. Then hindsight bias, that means selective memory of past events. So based on selective memory of past events, you are deciding what to buy and what not to buy, not based on core research. So whatever you can recollect on that basis. So recently, you will say, like, recently I'm seeing Mukesh Ambani's photo everywhere in the newspaper, so I will buy Reliance shares. Then it is hindsight bias, just based on selective memory of past events. Then cognitive errors, information processing. This heading is not needed. Only this is needed, okay, for you. This heading is not needed. Like anchoring and adjustment bias. This is related to conservatism only. You are anchored to your thoughts. Okay. You will find many overlapping terms, okay, here.
Yeah.
Okay. So anchored to your thoughts means what? Conservatism. Then
Yes.
mental accounting. Mental accounting means what? Say, for example, you are getting normal salary through which you are doing SIP investments in normal salary. And then suddenly you are getting some unexpected bonus. Now, when you got unexpected bonus, you are thinking, anyways, it is unexpected. Let me invest in penny stock. So what does that mean? Just because it is unexpected, does that mean this money does not have importance or it does not have value? Nothing like that, right? It also has equal value, just like your normal salary. But normal salary, you are investing very judiciously. Unexpected bonus, you are gambling. So that is called mental accounting.
Understood.
Okay, mental accounting. This is just our thinking that if I lose this bonus, it's okay for me. But I should invest my normal salary very judiciously. But money is money. Let it be unexpected bonus or normal salary. Okay. So that means if I lose money from my another pocket, I'm okay. But I should not lose money from this pocket. That thinking is called mental accounting.
Okay.
But both are our money only, right?
Mm.
That way it is not the right thinking, right? So that is mental accounting bias. Then framing bias. Framing means the way words are framed. Accordingly, we will also take decisions. For example, framing bias is, yeah. See, for example, see this here. United States is preparing for the outbreak of an unusual disease, which is expected to kill 600 people. Two alternative programs have been proposed. If program A is adopted, 200 people will be saved. If program so A will save 200 people. Okay, so 600 are expected to be killed. And B says one third probability that 600 will be saved, and one third probability that 600 will be saved, uh, and two-third probability that will not be no one will be saved. So two-third probability. So one third is how much? Just 200 will be saved, and this is should be 400. 400 will be killed. 200 saved and 400 killed. Okay. Uh, so in this case, see, A says 200 will be saved, and when I say one third will be saved and two-third will be killed, people will emphasize on this one. Two-third will be killed. So people say what? People will say, let me go
It
for
is
A.
better.
A. The way you are framing. So program A is typically selected. You understood the reason why? Actually, both are
Yes.
meaning the same thing. 200 directly saying saved, or saying that one third will be saved and two-third will be killed. That means I indirectly said 200 saved and 400 killed. It's the same thing as A, but people will
Yeah.
select A. It is about how you are framing. 200 people will be saved. A and B are telling the same thing, correct here.
Correct. Yeah.
One third will be saved means 200 will be saved and 400 will be killed. But people tend to see what they want to listen. Okay, they want to see that many, these people will be saved, so they will go for this one because this line does not have anybody killing. So that is framing bias. Okay, then same way here also, see, a different group of individuals is given the same issue, but two programs are framed differently. Now here it is framed differently. Program A, if program A is adopted, 400 people will die. See, same statement said in different way now. So 400 people will die. Okay. 400 people will die, and program B is adopted, there is one third probability that nobody will die. So one third probability nobody will die. So that means it's the same thing said. One third probability nobody will die. One third probability that nobody will die. And two-third probability that 600 will die. Which program will people choose? So in this situation, program B is typically selected. The majority choice is now risk taking, with the certain death of 400 people being less acceptable. Like, see, when I say 400 people will for sure die, okay, they will not like this line. Whereas these two has got the same meaning, no? I'm
Yes.
saying 200 people saved or 400 people will die. It means the same thing. But the second part they will not like. So they will go here for, second B option. And this is how the lines are framed. Okay, then availability bias. Availability means giving importance to those information which are readily available, easy to recall. This is kind of hindsight bias only. Okay. So see, what you have to do here, see, this chapter will go fine if you read in advance and then come back, because then you will know what doubts to be asked then. Okay, you will find all these overlapping stuff only. Okay, so instead of me going like this, what I think, see all this, you just read all this once, because all these are very self-explanatory, easy only. Then when you ask me doubts, it will be easy. Okay,
Okay.
all these are easy one only. All these are self-explanatory only. I'll tell you where you might, yeah, here this only I have to explain to you. This part, I'll explain, but rest is all easy only. After this, yeah, that's it. This will be over only. Okay.
Yeah. And so, can we revise the second chapter of portfolio management?
Yeah, yeah.
Yeah.
Okay. Second chapter of portfolio management. Okay.
Mm.
Fine, fine. Okay, so I'll do this then next time. Okay, that's that second
Okay.
chapter. What I will do, next time, we will wind up now. What I will do next time is I will recap the entire subject only altogether. Okay, but
Okay.
you please read this one theory and come, because that is all
Yes.
theoretical stuff. So if you read, it will be easier for me to quickly run through. Okay,
Okay.
and then we will do a recap of the entire subject, portfolio management. Okay,
Okay, sir.
okay, we'll stop now here. Okay,
Okay, sir.
okay,
Thank you,
okay.
sir.